Welcome to our module on business performance measurement, a crucial topic for any organization. We will focus on evaluating success through data and insights to make informed decisions. Okay, let us start by exploring the core concepts central to understanding business performance and its measurement. Specifically, we will delve into the definitions and distinctions between metrics, performance indicators, and key performance indicators. First, let us define business measurement, which is the foundational process for evaluating how well a business is performing. It is essentially the systematic process used to evaluate how effectively a business achieves its predetermined goals and objectives. This process involves tracking and analyzing various metrics to gain crucial insights into overall business efficiency and effectiveness. Ultimately, it is critical for making informed decisions and driving continuous improvement across all aspects of the organization. Now, let us turn our attention to what we call key business metrics, the specific data points we track. These are quantitative measures used to track the performance of very specific business operations and activities. Good examples include tracking your sales revenue over time or measuring the daily production output of your manufacturing line. These metrics allow us to directly observe and monitor the performance of individual business functions. Moving on, performance indicators are a broader category that provides deeper insights into objective achievement. They are metrics specifically chosen because they provide valuable insights into whether business objectives are being met. These indicators are always closely aligned with the company's overarching strategic goals and vision. This category encompasses various types, including key performance indicators as well as leading and lagging indicators. Finally, we have key performance indicators or KPIs, which are the most critical among them. KPIs are the critical indicators that directly reflect the success of a business in achieving its most important goals. They are essential for consistently tracking progress over time and assessing the overall health of the business. Most importantly, KPIs provide actionable insights, guiding strategic decisions for continuous improvement and growth. Now, let us explore the core categories that define different business metrics. These diverse perspectives offer a comprehensive and holistic view of overall business performance. First, we have financial metrics, which are fundamental to understanding a business. They help us assess a company's profitability and its overall financial stability. Next, customer metrics focus on the relationship a business has with its customers. These metrics track customer satisfaction, loyalty, and their overall experience with the company. Then, operational metrics evaluate the efficiency of daily business activities. They help assess how efficiently our day-to-day operations and processes are performed. We also consider employee performance to understand their impact on the business. This measures how employees contribute to the overall success of the company. Marketing metrics help us gauge the effectiveness of our promotional efforts. They evaluate how well marketing campaigns are working and their audience reach. Finally, growth metrics indicate the potential for future business expansion. These show how much a business can grow and expand in the future. Let's differentiate between leading and lagging indicators, which are important concepts. This distinction helps us understand what predicts the future versus what reflects past outcomes. Leading indicators, on one hand, are forward-looking measures. They help us predict what might happen with performance in the future. These indicators provide early signals to adjust our business strategy proactively. For instance, customer engagement rates can indicate future sales potential. Another example is website traffic volume, which predicts future customer interest. On the other hand, lagging indicators look back at what has already occurred. They measure the outcomes and results of actions taken in the past. These indicators show us what has already been achieved or completed. Quarterly revenue figures are a classic example, reflecting past financial performance. Similarly, profit margins indicate the profitability achieved in a previous period. To set effective KPIs, we use the SMART framework. This framework helps ensure our KPIs are clear and aligned with our strategy. The S in SMART stands for specific goals. This means your goals must be clear, precise, and well-defined. M means your KPIs should be measurable. You need to be able to quantify them so you can track progress. A stands for achievable, meaning realistic. Your targets should be realistic and genuinely attainable for your team. R means your KPIs must be relevant. They must align directly with your overall business objectives and strategy. Finally, T means your KPIs are time bound. You need a clear, defined time frame for achieving each objective. Now, let's delve into some key financial metrics, crucial for business analysis. We'll explore how to analyze revenue and understand how profits are generated. First, we have revenue analysis, which is the total income. This represents the total money a business earns from its activities. It serves as the foundation for all subsequent profitability calculations in finance. For example, total revenue equals price per unit times the quantity sold. Next, profitability analysis helps us understand a company's earnings. This analyzes how effectively a company converts its revenue into profit. Gross profit margin is calculated as revenue minus COGS divided by revenue, all multiplied by 100. Net profit margin is net income divided by revenue multiplied by 100. We also examine return on investment or ROI in various forms. Return on assets or ROA is net income divided by total assets multiplied by 100. Return on equity or ROE is net income divided by shareholders' equity multiplied by 100. EB. IT measures a company's core operational profit before interest and taxes. Let's now explore cost analysis and the profit and loss statement. This helps us grasp expenses and assess a business's overall financial health. First, the cost of goods sold or COGS represents direct production costs. These are the direct expenses involved in creating the products or services sold. The formula is opening inventory plus purchases minus closing inventory. COGS is vital for accurately calculating a company's gross profit. Operating expenses are all costs not directly tied to production. These include costs necessary to run the business but not directly for making products. They cover the essential costs for the business's daily functioning. Common examples include rent, utility bills, and employee salaries. Break-even analysis determines the point where revenue equals total costs. This is the sales level, where a business makes neither a profit nor a loss. At this point, the business is simply covering all its expenses. Its fixed cost divided by the difference between price per unit and variable cost per unit. The P&L statement summarizes a company's revenues and expenses. It provides a clear overview of financial performance over a specific period. This statement offers key insights into a company's profitability and financial well-being. Its key parts include revenue, COGS, gross profit, and net income. Now, let's discuss the essentials of supply chain analytics for efficiency. We'll focus on how to optimize inventory and logistics to improve overall efficiency. Inventory management is crucial for controlling the flow of goods. It involves managing stock levels to meet customer demand and reduce expenses. The inventory turnover ratio measures how quickly stock is sold. This ratio indicates how efficiently a company manages its inventory over time. Days Inventory Outstanding or DIO tells us average selling time. It calculates the average time required to convert inventory into sales. Economic Order Quantity or EOQ determines the ideal order size. This formula helps find the optimal quantity to order, minimizing overall inventory expenses. Logistics optimization aims to improve transportation and distribution. It streamlines the processes of moving goods, enhancing overall efficiency. The on-time delivery rate is the percentage of punctual deliveries. This metric reflects the reliability of a company's delivery service to customers. Let us explore several strategies for enhancing supply chain efficiency. We can apply lean principles to eliminate waste and optimize processes. Accurate demand forecasting helps us anticipate customer needs effectively. Predictive analytics uses data to foresee future supply chain events. IoT and cloud technology provide real-time data and collaboration. Ultimately, these strategies lead to optimized and more efficient operations. We will now focus on operational analytics for productivity and quality. This involves maximizing output while consistently maintaining high standards. Let's start with productivity metrics, which measure efficiency. Labor productivity shows the output generated for each unit of labor input. Asset utilization measures how efficiently assets are used to generate revenue. Throughput represents the amount of work or units processed within a given time. Cycle time indicates how long it takes to complete a single unit of work. Next, we have quality metrics, which ensure products meet standards. Defects per unit indicate the number of flaws found in a single product. First pass yield measures. Products that are correct the first time. Customer satisfaction score gauges how happy customers are with a product or service. Cost of quality includes all expenses to prevent, detect, and fix defects. We will now look at the TechCo case study on implementing changes. This case highlights using data-driven actions to achieve business growth. One key task for TechCo was to optimize its sales and marketing efforts. A major step was refining customer targeting to reach the right audience. This involved focusing resources on customer segments that are more profitable. The goal was also to minimize unnecessary spending in the marketing budget. Another important step was to improve the overall sales funnel. This included introducing new campaigns to effectively nurture potential leads. They also aimed to target high-value prospects with tailored, personalized offers. Implementing a CRM system was also a significant step. This helped track customer interactions to enable better personalization. Ultimately, the CRM system helped reduce the customer acquisition cost. TechCo also focused on enhancing its overall operational efficiency. A key action was to optimize inventory levels to prevent overstocking. This involved using predictive analytics to manage stock more effectively. The goal was to reduce storage expenses and avoid excess inventory. Automating various processes was another significant improvement. This meant investing in RPA&A tools for the supply chain. The aim was to shorten order fulfillment cycle times for better service. Upgrading equipment and providing training were also crucial. This included offering more training programs for the workforce. They also upgraded their manufacturing equipment to improve production. Finally, TechCo aimed to boost product quality and customer satisfaction. Implementing stricter quality control measures was a major step. This involved using automated systems to detect defects early on. The ultimate goal was to significantly reduce defects in production. Improving customer service was also a critical area of focus. This meant improving response times and strengthening the support team. They also worked to make the product returns process much smoother. Well, let's summarize the key points from our lesson today. These are the essential takeaways for understanding business performance measurement. KPIs, guided by SMART criteria, are crucial for tracking performance and making informed decisions. Business metrics cover financial, customer, operational, employee, marketing, and growth categories for a complete view. Leading indicators forecast future trends, while lagging indicators reflect results from the past. Financial analytics optimizes revenue, profitability, and cost structures using data-driven insights effectively. Supply chain analytics improves inventory, logistics, and overall operational efficiency significantly. Operational analytics boosts productivity, quality, and implements effective risk management strategies.